Welcome to the deep dive. Today, we're getting into the financials of two LiDAR companies, Ouster, that's OUST, and Hesai Technology, HSAI.
That's right. We've got data up to early May 2025, plus some trend info from the start of the year.
And our mission here is really to compare their financial standing, see how they stack up against each other, and maybe find some, surprising differences.
Exactly. Looking at things like market cap, revenue, cash flow, going a bit deeper than just the share price.
Okay, so let's start with market capitalization, big picture view.
Well, as of May 5th, Hesai's market cap is way bigger. We're talking $2.376 billion.
Wow, okay, and Ouster.
Ouster's sitting at about 448 million. So yeah, quite a gap there in just overall market
A
valuation.
huge gap, but you mentioned trends.
Yes, and this is where it gets interesting. Since January 1st, 2025, Ouster's market cap has actually climbed quite a bit.
Oh, really?
Yeah, suggesting maybe some growing investor confidence. Hard to say for sure, but it's noticeable. Hesai, on the other hand,
Let me guess, down.
down over the same period. So you've got this divergence happening. It kind of makes you wonder about market perceptions shifting.
Definitely. Okay, moving on. Revenue per share and book value per share. Book value being uh, assets minus liabilities per share.
Right. And here again, Hesai comes out ahead on both metrics compared to Ouster.
So higher numbers for his eye there. What does that generally indicate?
Well, higher revenue per share often points to better income generation relative to the shares out there. And higher book value can suggest a stronger asset base per share.
So on paper, maybe a more robust foundation for his eye on a per share level.
Potentially, yes. Seems that way based on these numbers.
Okay, let's switch gears to profitability. Oh, EBITDA.
Yeah, not great news for either, frankly. Both have negative EBITDA, that's earnings before interest, taxes, depreciation, amortization, a key profitability measure.
Both negative, but is there a difference?
Oh, yeah. Hesai's negative EBITDA is significantly larger, much more negative than Ouster's.
And does that pattern hold for operating income and free cash flow too?
It does. Both metrics are negative for both companies, but again, Hesai's numbers are, well, deeper in the red.
So Ouster seems to be burning through less cash, relatively speaking.
That's what it looks like, yes. Less negative free cash flow. It does raise questions about their strategies, doesn't it?
How so?
Well, Hesai's bigger negative numbers could mean they're investing really heavily in growth, R&D, market expansion, that kind of thing. Aggressive moves.
Whereas Ouster,
Ouster's smaller negative figures might suggest more focus on maybe cost control, efficiency, managing capital carefully, different paths.
makes sense. Okay, turning to the balance sheet itself. Assets, liabilities, cash.
Right. So Hesai has more total cash per share, also higher total assets overall compared to Ouster.
More resources on hand then. But liabilities.
That's where Ouster looks a bit different. Ouster actually has lower total liabilities than Hesai.
Interesting. So Hesai has more firepower in terms of cash and assets, but Ouster has less weighing it down in terms of debt or obligations.
Precisely. Hesai's cash gives them flexibility, maybe for acquisitions or weathering storms. But Ouster's lower liability profile could mean more stability, especially if the market gets tight.
Got it. One last piece. Ownership structure. Free float.
Yeah, this is quite a contrast, too. Ouster has a really high free float. About 90% of their shares are out there, freely traded by the public.
90%. Okay, and Hesai?
Lower, around 74%, still substantial, but noticeably less than Ouster, meaning a larger chunk is likely held by insiders or long-term strategic investors.
What's the potential impact of that difference?
Well, a higher free float like Ouster's can mean more liquidity, easier trading, but maybe more price volatility sometimes too.
And Hesai's lower float.
Could imply perhaps a bit more price stability, maybe less day-to-day noise, but potentially thinner trading volume. It's a trade-off.
Okay, so let's try to wrap this up. We've got Hesai, bigger market cap, higher per share revenue, and book value, more assets.
Yeah. But also much larger negative profitability metrics, higher cash burn, and lower free float. Seems like a growth-focused play, perhaps accepting bigger losses for now.
And Ouster. Smaller scale overall, lower market cap, but less negative cash flow, lower liabilities, and a very high free float.
Yeah, maybe suggesting a path focused more on controlled growth, financial efficiency, and a stock structure that's very open to the public market.
Fascinating contrast. So here's something for you, the listener, to think about. Given these distinct financial pictures and ownership details, What might this tell us about their future strategies?
Right, and the potential risks or vulnerabilities each might face in this really competitive LiDAR market.
And are there other crucial factors beyond just these financials, maybe things like specific technology advantages, key partnerships, or regulatory shifts in autonomy that you'd need to really get the full story? Something to mull over. Join us next time on The Deep Dive.